Lilladher joins in with his report, which he's titled Aces in the Pack. Hi Surjit, thanks for joining in. First, let's talk about LG Balakrishna. What is this stock about and why do you like it?
Thank you for the opportunity. If you look at LG Balakrishna per se, they are the leaders in automotive chains, mainly for motorcycle segment, and they command an easy 60-65% market share in that segment. And if you look at last 5 to 6 years history of the company, they have been easily maintaining that 11 to 12% EBITDA margin range, with also generating free cash and a consistent dividend payout policy. Last 7 years average dividend payout has been around 15 to 16%, with a healthy return on equity of around 20% plus, and with a decent 17 to 18% top line CAGR for last 3-4 years, and that trend is likely to continue. Mainly they are focused on two-wheelers, but because now Honda is getting very aggressive in the market, they are one of the leading suppliers to Honda in terms of automotive chains. So going forward, with our estimate of 13 to 14% volume growth in the two-wheeler sector, at least for next couple of years, we believe LG Balakrishna, who is a leader in automotive chains, with a decent management and a strong balance sheet, with return ratios in excess of 20%, and growth going forward will be around 21-22% in terms of earnings CAGR for next 2 to 3 years. The stock currently, despite the run-up, as you rightly pointed out, the stock currently is trading at some 10.5 times FY16 earnings and around 9 times FY17. So yes, the stock has run up, but given the fundamentals, we believe the stock will continue to surprise positively on the earnings front, and the volume growth will mirror the two-wheeler segment growth, which is pegged at 13 to 14% for next couple of years.
Hi Surjit, good afternoon. The other stock that I'd really like to focus on is Gabriel India. This year that stock is up over 200%, but in the last, I think, 1 or 2 months, it's moved almost in a straight line from those 50 levels now to 80. What's the story there? Can it go much higher from here?
See, if you look at the run-up in the stock, yes, I agree with you. It has been quite steep compared to other companies in our coverage. But then the thing, there is a couple of pointers. One, the commercial vehicle plant, which is currently utilizing the capacity at only 40%, has been beaten down due to the downturn in medium and heavy commercial vehicle segment. However, we feel for next couple of years, we have already seen the bottom in place in terms of commercial vehicle sales, and going forward, there could be 25 to 30% kind of growth in FY16 and FY17 for commercial vehicles. So given that the utilization will improve with improvement in overall volumes, their margin profile will improve substantially, given that CVs have higher margin for them, and plus if you look at the company per se, their overall capacity utilization on a blended basis, because they are also into two-wheelers and four-wheelers, the blended utilization is hardly at 60-65%. So the operating leverage will be quite high in this company. So even if a 15-16% CAGR in top line, given both four-wheelers as well as two-wheelers will grow in that particular range, I believe the operating leverage will kick in with higher utilization capacity. Plus they have cut down their debt because of higher profitability and lower working capital requirement. So going forward with 16% top line growth, EBITDA growth because of operating leverage could be as high as 24%, and because debt has been reduced substantially from 140 crores to almost 54-55 crores now, I believe there will be a lot of saving on the interest cost front also. So that will translate almost in 32% CAGR in earnings for next 2 to 3 years. But having said that, in our report also we clearly mentioned that given the steep run up in the stock, we would advise clients buying into a stock at some correction in the stock, not at 80 bucks, let's say at 8 to 10% correction from here on. Given the steep run up, we would be buyers in the stock, and hence we did not give a buy on this. We maintained the accumulate rating, given that the run up has been quite steep. But it's more of an operating leverage story here compared to LG Balakrishna, which is more of a structural, sustainable story with higher market share. I mean, for Gabriel, last point is in CVs, they have 75 to 80% market share, so they are the leaders there. However, on the two-wheeler front, they have a lot of competition, and being an OE supplier, their margins from 7% at best might go to 9 to 10%. So they will not benefit in terms of double-digit margin going forward. But because their margins already were at 7%, I believe there could be a substantial improvement from 7% to 9% over next 2 years. So the earnings growth and the cash flow generation will be quite healthy, at least for the next couple of years. So yes, to answer your question, at lower levels, one can definitely look at Gabriel with a target price of 100 from, which gives you 25-30% upside from the current levels.
Okay, and very quickly on Suprajit Engineering.
See, Suprajit, the management is quite focused on getting new orders from new customers. Like recently, they also made an inroad into BMW suppliers globally. So that's a big thing for a company which has 1500 crores market cap. And if you look at historically also, their return on equity has been quite stable at 25-26% with asset turn of almost 4 times the fixed asset. So net, given the strong balance sheet and given that cash flow generation has been quite healthy, and given the earnings CAGR of 27-28%, again driven by two-wheelers as well as on the car side, because now BMW, Volkswagen all are giving new orders to Suprajit. So the revenue visibility in this company is like 22% CAGR for next 2 to 3 years in terms of revenue. And given that high operating leverage and cost cutting, I believe bottom line growth could be as high as 28%. So valuation, yes, are demanding at 18 times FY16, but I believe with a slightly longer term view, when you look at FY17 from a 1 year point of view, I think valuation are still at 13.5 times 1 year forward. Given the robust 28% CAGR in earnings with 26-27% return on equity, I believe still this company has a lot to surprise on the positive side and give investors return to a tune of 25-30% over next 12 to 15 months prime frame. So all these 3 companies, balance sheets are very strong, growth profile is very, very robust. Though valuations have run up, we are recommending clients to accumulate these stocks on any correction going forward. So we are quite positive on these 3 companies.
All right, Surjit, any disclosures you want to give?
Yeah, we have been recommending these 3 stocks to our clients. So yes, our institutional clients might have holding in these stocks. That's a disclosure I would like to give.
All right, thanks very much for joining in with your